Bitcoin is best understood as a globally shared ledger asset whose valuation is shaped by marginal flows across many venues, rather than by a single narrative. The most durable advances usually occur when incremental buyers appear across multiple channels, retail participation, institutional allocation, and cross-border demand, while the most damaging drawdowns often arrive when crowded positioning meets thin real demand and forced selling accelerates. Participation quality and how to read it. A useful distinction is between chase flow and sponsorship flow. Chase flow is reactive. It arrives after strong green sessions. It tends to vanish when momentum slows. Sponsorship flow is steadier. It accumulates during boredom. It absorbs supply during pullbacks. It often comes from players with longer planning horizons. You can often infer the difference by observing how Bitcoin behaves after sharp moves. If rebounds are immediate and orderly, that can suggest underlying sponsorship. If rebounds are slow and easily sold, that can suggest the prior rally was mainly chase flow. Supply behavior through the lens of coin mobility. Because the issuance stream is comparatively small relative to the outstanding stock, the decisive variable is whether existing holders choose to mobilize coins. When older holdings begin moving during strength, that frequently indicates distribution from patient holders into fresh demand. When older holdings remain inert even as valuation rises, that can indicate conviction and a tighter available float. Changes in coin mobility are not a timing signal by themselves, but they can explain why certain rallies stall while others extend. Market plumbing and the path of least resistance. Bitcoin trades in a fragmented landscape, with liquidity distributed across spot venues, futures venues, and off-exchange bilateral routes. Fragmentation matters because it can create short-lived dislocations, especially when one venue experiences order book thinning or operational friction. When depth is uneven, the path of least resistance can dominate, meaning the market moves toward the side where few resting orders exist, producing swift jumps and equally swift drops. Leverage transmission without using leverage as a strategy. Large intraday swings often originate from liquidations, margin calls, and position reductions that must be executed immediately. Even if you never trade with borrowed exposure, you still live inside a market where others do, so understanding the cascade mechanism is valuable. The practical signal is not a single metric, but a cluster: rising futures basis, aggressive long bias, and increasing sensitivity to small headlines. When that cluster appears, a seemingly minor downtick can become an outsized move as forced selling feeds on itself. Volatility as information rather than noise. Bitcoin volatility is not merely a nuisance, it is the language the market uses to clear imbalances. A compression phase with narrowing ranges can indicate that two-sided interest is building. When the range breaks, follow-through depends on whether the move attracts new participation or simply triggers stocks. A wide range phase with repeated large candles can indicate churn, where big players transfer inventory while the crowd overreacts. In that churn regime, directional conviction often underperforms careful risk budgeting. Technical decision points framed as behavior zones. Instead of fixing on a single indicator line, it can be more robust to define zones where behavior changes. One zone is the balance area, where repeated closes occur, and the market agrees on value for a time. Another zone is the discovery area, where the market explores prices not recently accepted. A third zone is the failure area, where expressions are rejected and price snaps back into balance. Traders often lose money by assuming discovery will continue when the market is actually failing, or by assuming failure when discovery has real sponsorship behind it. Time highs in alignment and a clean rating model. Bitcoin rewards clear separation between long horizon holdings and tactical activity. Long horizon exposure benefits from a simple plan, periodic rebalancing, and custody discipline. Tactical activity benefits from predefined invalidation, small size relative to account equity, and respect for volatility expansion. Mixing these two modes without explicit rules usually produces emotional decisions, buying late, selling low, and overshooting during noise. Hazards specific to Bitcoin ownership. Operational vulnerability remains a major factor. Key loss, phishing, and custody. Mistakes can be more damaging than market drawdowns. Network fees can spike during stress, making transfers slower or more expensive, which matters when you need to reposition quickly. Venue outages can occur during peak volatility, which can trap capital at the worst moment. Jurisdictional policy shifts can also affect access on ramps and derivatives availability, altering market structure even if the underlying protocol remains unchanged. USDT perspective. USDT is a dollar reference token used primarily for settlement, collateral, and cross-venue transfer. Its utility comes from reach and integration. While it aims to hold parity with $1, the token should be treated as an instrument with operational and credit dimensions, not as the same thing as insured bank cash. Parity formation and where deviations come from. USDT parity is maintained by arbitrage and convertibility. When secondary markets quote below $1, buyers step in if they believe conversion to dollars remains available at scale. When secondary markets quote above $1, sellers appear if supply can be created or sourced efficiently. Breaks in parity typically come from friction, redemption bottlenecks, venue-specific withdrawal halts, chain congestion, or a sudden demand surge for immediate off-ramp that overwhelms market maker capacity. Reserve quality, liquidity, and time to cash. The central question for any stable token is how rapidly the backing can be transformed into dollars during heavy redemption. Assets with short duration and high market depth are easier to liquidate with minimal slippage. Assets with longer duration, lower depth, or higher counterparty concentration can create stress under pressure. Even if ultimate solvency is intact, timing matters. If holders cannot access dollars,